Why do most traders lose money in the stock market? This video breaks down the 5 biggest mistakes that cost beginners and even experienced traders their success. Before we continue, please subscribe, hit a like button, or leave a comment below. Thank you. The journey begins with the promise of quick wealth. Picture the flashy advertisements on social media, charts exploding upward, influencers boasting of doubling their accounts overnight, and friends whispering about easy wins. For newcomers, the stock market looks like a golden ticket. They open a trading app, see the prices moving, and believe that with just a few taps, profits will come rolling in. What they rarely realize is that behind every winning story, there are dozens of losses that no one shares. The first mistake reveals itself almost immediately: lack of a defined strategy. Many traders rush in without writing down a plan. They buy a stock because it is trending on Twitter or because a colleague mentioned it over coffee. Entry and exit points are undefined, risk limits are ignored, and profit targets do not exist. Without a clear map, they wander blindly through a stormy market, reacting to every swing in price instead of following a structured path. Statistics underline this harsh reality. Research shows that more than 80% of day traders quit within their first 2 years. Why? Because without a plan, the market feels like a casino. Every decision is emotional, every win feels like luck, and every loss feels personal. A defined strategy is not just about numbers, it provides psychological stability. Traders without it experience the wild roller coaster of joy and despair until they finally give up. Imagine a rookie trader buying a stock at random, watching it go up for 10 minutes, and selling for a tiny profit. They celebrate as if they cracked the code. Emboldened, they place another trade, but this time the stock drops. Panic sets in. Should they hold? Should they sell? With no plan to guide them, emotions dictate their next move, often locking in losses or chasing rebounds that never arrive. It is not discipline guiding them, but adrenaline, and adrenaline is a poor teacher in financial markets. This is why the illusion of easy money is so dangerous. The excitement of quick profits masks the truth that the stock market is unforgiving to those without preparation. A trading plan is like armor. Without it, every market move becomes a sword strike against unprotected emotions. By the end of this first stage, the lesson is clear. Without a defined strategy, a trader is not investing. They are gambling, and in the long run, the house always wins. Even traders who think they have a plan often stumble when it comes to risk. The second reason many lose money is simple. They risk too much on each trade. In the excitement of chasing profits, it is common to put half of a trading account into a single stock. It feels logical: bigger position, bigger win. But the flip side is devastating. One wrong move can wipe out weeks or months of progress. The principle of survival in markets is simple: never risk what you cannot afford to lose. Risk management tools exist for a reason, yet too many traders ignore them. The most important of these is the stop-loss order, a mechanism that limits how much money is lost on a single trade. Professionals place stop-losses religiously, while beginners often avoid them, thinking the stock will bounce back. But markets are merciless. A position that was supposed to recover can sink lower and lower until the account balance looks like a desert. Leverage makes the trap even more dangerous. Many brokers offer the ability to borrow money to trade bigger positions. New traders see this as a shortcut to wealth. Yet leverage is a double-edged sword. A small move against a leveraged position can cause catastrophic losses in seconds. What was supposed to be a dream of multiplying profits becomes a nightmare of liquidation. Traders discover too late that leverage without discipline is like giving a child a loaded weapon. The psychological toll of poor risk management is immense. Imagine watching your savings shrink 30% in a single day because of one reckless trade. The panic sets in, clouding judgment. Traders begin chasing losses, doubling down in desperation, which often makes the damage even worse. Instead of cutting losses quickly and preserving capital, they gamble bigger, telling themselves they can recover. This is not trading anymore. It is emotional self-destruction. True professionals understand that capital preservation is victory. Making money comes later. The goal in the early stages is survival. Risking no more than 1 or 2% of total capital per trade, setting disciplined stop losses, and never letting emotions override protective rules are the foundations of longevity. Without risk management, even the best trading strategy will eventually fail. Stage 2 drives home the lesson. The difference between lasting in the market and burning out fast is not luck or timing. It is strict, unwavering discipline in managing risk. The third major reason traders lose money is overtrading. At first, it looks like dedication. People sit in front of their screens for hours, clicking buy and sell endlessly, convinced that the more they trade, the more they will earn. In reality, this habit drains accounts slowly. Every transaction carries costs, spreads, commissions, slippage. These hidden cuts add up until profits vanish. Overtrading is not productivity. It is self-sabotage disguised as effort. Why do traders overtrade? Often, it comes from boredom or restlessness. Financial markets move in cycles, and sometimes they are quiet for days. Instead of waiting for a high-probability setup, impatient traders jump into mediocre trades just to feel active. The need to do something pushes them into unnecessary risks. But the best traders know patience is money. Doing nothing is often more profitable than forcing trades that have no clear edge. Another root of overtrading is the illusion of recovery. After a losing trade, many believe the next trade must be the one that makes it back. They enter again too soon, with too much size, chasing the loss. One loss turns into five turn into 10. Before long, the account balance has cratered. Professionals break this cycle by following strict rules. Never revenge trade, and always step away after hitting a daily limit of losses. Overtrading is also fueled by dopamine. Each executed trade releases a psychological thrill, even before profits or losses are known. It feels like pulling a slot machine lever, and the brain gets hooked. This is how trading shifts from a calculated profession into gambling. Recognizing this addiction is key. Journaling trades, tracking performance, and reviewing statistics can expose just how often overtrading destroys results compared to well-timed entries. The antidote is structure. The most successful traders often set strict daily trade limits and commit to only entering when all conditions of their plan align. They build watch lists, use alerts, and wait. Overtrading drains both accounts and energy, leaving traders exhausted and discouraged. Stage 3 proves that in markets, less can truly be more. Mastery is not about how many times you click the button, but how precise and disciplined you are in choosing when to act. The fourth major reason traders lose money is emotions taking control of decisions. Markets move fast, and the brain responds with adrenaline and fear. Without a plan, traders act on instinct rather than logic. Buying too high because of excitement or selling too low because of panic is a direct result of emotion overriding strategy. Every profitable trader learns that discipline, not emotion, must sit in the driver's seat. One of the strongest emotions is fear of missing out, often called FOMO. A stock or index surges higher, social media explodes with hype, and the trader rushes to buy late. By the time they enter, momentum slows and losses follow. FOMO convinces people that opportunities are rare, but in reality, markets create setups every day. The cure is patience and the belief that missing one trade does not mean missing success. Another damaging emotion is fear itself during downturns. Traders often see red on their screens and panic sell, even when the market is only making a temporary pullback. They abandon their plan and lock in losses, only to watch the price recover shortly after. This cycle of fear-driven selling erodes accounts. Professional traders accept that drawdowns are part of the game, and they trust their risk management instead of emotions. Then comes hope and stubbornness. Traders hold losing positions far too long, hoping the price will return to their entry. Instead of cutting a loss quickly, they let it grow larger and larger. Hope becomes denial, and denial becomes destruction. Markets punish those who refuse to admit they are wrong. Successful traders practice humility. They accept small losses quickly to preserve capital for the next opportunity. The solution to emotional trading is building habits that replace feelings with structure. This means following a written plan, using stop losses, journaling trades, and even stepping away when emotions rise. Emotional mastery separates the amateurs from the professionals. Stage 4 makes one truth clear. The market does not reward feelings, it rewards discipline. Only by controlling emotions can traders hope to build lasting success. The final major reason traders lose money is chasing overhyped stocks. These are the hot picks everyone talks about on social media or the evening news. They rise quickly because of buzz, but often without solid fundamentals behind them. Traders jump in expecting endless gains, but markets usually punish late entries into hype-driven moves. By the time most people hear about it, the price is already inflated. The psychology behind hype is powerful. When friends, influencers, or headlines all point to the same stock, it creates a false sense of certainty. Traders believe, everyone else is making money, I must too. But what usually happens is that insiders and early buyers quietly sell into the excitement while latecomers carry the losses. This cycle repeats with every bubble, from dot-coms to meme stocks. The danger is not only financial, but also mental. Losing money in a hyped stock can damage confidence and push traders into reckless revenge trading to win it back. They start doubling down on the next trendy pick, ignoring risk rules, and the spiral deepens. The market punishes herd behavior, teaching over and over that discipline matters more than excitement. The solution is to step back and ask, am I buying this stock because it is truly undervalued or because everyone is shouting about it? Smart traders rely on research, fundamentals, and technical setups instead of noise. If the hype aligns with a solid strategy, maybe it is worth the risk, but blindly following trends without analysis is like gambling, not trading. To close, overhyped stocks symbolize all the mistakes we covered in earlier stages: lack of strategy, weak risk management, overtrading, and emotional decision-making. They lure traders with the promise of fast money, but often leave them with regret. Avoiding the hype requires patience, discipline, and trust in your own process. That is how traders move from chasing illusions to building consistent, long-term success in the markets. This is the end of that story. Now tell me in the comments, what's your story? I'll read out the most interesting ones in the next video. Do not forget to hit a like button and subscribe. See you.